Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi ta'ala wabarakatuh. Okay, this is actually the second part of the presentation that relates to the objective and the scope of the financial statements audit. Okay, to inform that this is actually the topic for the first audit paper of the degree level program. Let's continue. Right, in the first video, okay, I have actually explained to you about the audit objectives and the auditor's responsibility. Okay, in this presentation, I'm going to discuss about management assertion and the transaction related as well as the balance related audit objective. What is management assertion? Okay, according to what we have here is management assertions are implied or express representation by management about classes of transaction and the related accounts in the financial statement. Okay, for a very simple understanding, management assertion can be related to management claim. So the financial statements are actually being prepared by the management. So whatever included by the management in the financial statements are what being claimed by the management. And when the management prepare the financial statement, they have to actually comply with the financial reporting framework. So you can see that the management assertions are actually related directly to the generally accepted accounting principles or are related to the financial reporting framework. So you also see that here assertions therefore are actually part of the criteria that the management use to record and disclose accounting information in the financial statements. Okay, in relation to audit, the auditor has to carry out audit tests on this management assertion to determine what have been claimed by the management, have been properly claimed and have been properly comply with the financial reporting framework. Management assertion can be divided into 7 categories according to the ISA 500. These are existence, occurrence, rights, obligation, completeness, valuation, measurement, and the presentation and disclosure. I have given to you acronym here based on the current situation that we are facing. So you can see here, you can read this for yourself. Okay, existence assertion. Okay, existence assertion, this is usually related to asset, obligation, and equities. It means that whatever that have been recorded in the financial statements are actually existed at the balance sheet date. The next assertion is occurrence. Okay. So what does it mean by occurrence here? It means that the financial statements contain items that have actually occurred. So if it does not occur, therefore it should not appear in the financial statements. Rights and obligation assertion is actually related to asset and liabilities. So the assets are actually the rights of the company and the obligations are the liabilities of the company. So when the assets are belonging to the company, therefore they have to be stated or included in the financial statements. Similarly, the obligations, the liabilities, they have to be included. Completeness assertion is related to a situation where whatever that have been recorded in the financial statement is being assumed that they have been completely recorded or stated. It means that there are no transactions been omitted or no account balance that have been omitted. Valuation assertion is related to the amount that are included in the financial statements, be it asset, liability, equity, or revenue. So these items, they have to be appropriately stated in the financial statements. Okay, the next one is related to measurement assertion. Okay, measurement is actually a situation where the transactions or events is recorded at the proper amount, and the revenue and expense are allocated to the proper period. So when we say measurement here, it means that it has to be recorded um, based on the amount that have been incurred, and the revenue expenses have to be recorded in the period in which they have occurred. The last assertion is presentation and disclosure assertion. Okay, in this situation, the management claim that all the items that are included in the financial statement, they have been properly presented and disclosed in accordance with the financial reporting framework, such as the Companies Act and the accounting standards. Okay, how the assertions are related to the audit? Uh, because assertions are management's claim about the transaction or balances in the financial statements, the auditor has to verify this. So the auditor has to develop, first of all, the audit objective to audit the management assertion, and this is called as audit objectives. Okay, when the auditor is going to audit the items that are related to the transaction, the auditor therefore has to develop the transaction related audit objective. Okay, and if the auditor is going to audit assertion that relates to the account balances, the auditor has to develop the uh, balance related audit objective. The transaction or balance related audit objective, they can be classified into general and specific audit objectives. The auditor has to develop both, actually, the general audit objective first of all, and then after that the auditor has to develop the specific audit objective. Okay, what is general audit objective? General audit objective is where the auditor form the objective in general. That means it's for a class of transaction or for a class of account balance. Specific audit objective, on the other hand, is where the auditor form the objective specific to certain item. For example, like let's say the auditor would like to determine whether the credit sales transaction have been correctly journalized and posted to the sales ledger. So the auditor has to form the objective, like to ensure credit sale transaction are correctly journalized and posted to sales ledger. Transaction-related audit objectives can be divided into 6. The first one is existence, then completeness, accuracy, classification, timing, posting, and summarization. Okay, these audit objectives are related to the management assertion that relates to classes of transaction. So when the auditor is going to audit the classes of transaction that relates to existence, then the auditor is going to form existence transaction related audit objective. Similarly, if let's say the auditor is going to audit management assertion that relates to completeness of the transaction, the auditor is going to develop the completeness transaction related audit objective. Accuracy is similar to completeness and existence. So this is where the auditor will set the objective that the auditor is going to determine whether the transaction that the company has occurred will be accurately stated in the books of the accounts. Classification relates to a situation where that the transaction are being classified according to its categories or according to certain categories. Timing is related to a situation where the auditor would like to know whether the expenses or the revenues are being properly measured. Okay? So meaning that they are properly stated or properly recorded in the period in which they have occurred, yeah, or arise. Posting and summarization is actually related to a transaction. For instance, the transaction has been first of all recorded in the journal, then after that they have been posted appropriately to the respective ledger, and then after that summarized. The balance related audit objective, there are 8 categories for this, and you can see that the first 4, existence, completeness, accuracy, classification, these are similar to the transaction related audit objective. And the other 4, cut off, detail tie-in, net realizable value, rights and obligation, these are because it's unique to the account balances. Okay, let's look at the cut off. The first 4 I'm not going to discuss because these are similar to the balance to the transaction related audit objective. Okay, let's look at the cut off. Cut off, maybe you can relate this to the inventory. Companies constantly buy and sell inventory, and the buying and selling of the inventory will span over a few years. Let's say the auditor is auditing the present or the current year, and for the following year, the company will keep on buying and selling the inventory. So the auditor is going to determine the appropriate amount that has to be recorded for the current accounting period and for the following accounting period for the inventory. So that is actually what meant by the cut-off. Detail tie-in is a situation where a few items, a few account balances in the financial statement can be related to one another. So therefore, the auditor can actually look into this item and determine whether they are appropriate or not appropriate. Okay, the next one is related to net realizable value. Okay, net realizable value is actually the amount that can be realized. For instance, let's say we look at the accounts receivable. Okay, accounts receivable, there are situations where the company may not able to recover all of its accounts receivable, maybe due to bankruptcy of the debtor. So here, the auditor is going to determine the appropriate net realizable value for accounts receivable and whether the same amount has been estimated by the management. Okay, lastly, the rights and obligation. These are related to assets and liabilities respectively. So when the assets are belonging to the company, these are company's rights. So they have to be, the asset have to be included in the financial statements. If the asset are not the rights of the company, it belongs to some other organization or entity, then these assets have to be excluded from the financial statements. Similarly, for obligation, these are the liabilities. Only the liabilities of the company have to be included. But if, let's say, they are not belonging to the company, these liabilities have to be excluded. Usually for asset, there is a possibility that management might overstate the asset, and for the obligation or liability, the company usually or the management usually understate. So for auditor has to determine that these are properly, appropriately stated in the financial statements. Now let's look at the relationship between assertion and the audit objectives. You can see that there is actually a very close relationship between assertion and the audit objective here. So there is a relationship between management assertion and the transaction related audit objective. Similarly, there are relationships between management assertion and the balance related audit objective. So as auditor, as I said earlier, the auditor has to audit this management assertion, and to audit this management assertion, the auditor first of all have to develop the audit objective, and this audit objective has to be based on the management assertion. Right, that's all for this topic on the management assertion and the transaction and balance related audit objective. Thank you for listening.